Okay, for your life insurance licensing exam, there's going to be a section, usually in the first couple chapters, on underwriting. At least in the courses that I've gone through, there's something on underwriting. Now, underwriting is the risk selection and classification process. It's very important you know this stuff, not only for your exam, but when you sell life insurance in the future, okay? So it's the risk selection and classification process where the insurance company decides, are we going to accept you for a policy? What's your rate going to be? Meaning, what's your premium? How much are you going to pay every month? What risk are you to us? Okay? There are many different factors involved to determine if the client's going to be offered insurance coverage or not. So it's essentially, we're determining in underwriting what the client qualifies for, if they qualify for anything at all, and what they're going to pay. Okay? So the agent, you're the first line of underwriting. So you are the first line of that risk selection and classification process for the insurance company. You prevent adverse selection. So you prevent, hey, am I going to apply for a policy when I know this person isn't healthy? Right? You help make sure the application's done properly. You make sure sales are done ethically. You make sure that the initial premium is collected, the first payment. You make sure that signatures are obtained on the application. And you make sure that the policy is delivered. Okay? Those are your main responsibilities as an insurance agent, being the field underwriter in the front line of underwriting for the insurance carrier. Now, next we have a big topic in insurance called insurable interest. So an insurable interest, it means that the policy owner would lose something if the insured dies, such as an income or a debt would be taken on. So it means that the policy owner is liable for a loss. Right, there will be a loss. I'll give you a good example, car insurance. So if you have a car insurance, I know we're talking about life insurance here, but car insurance, you are liable for the damages to your car or to someone else's car if you're in an accident, or to someone else's body. Like, you are liable for that loss of money that could happen if you damage someone else's body, someone else's car, or property or whatever, okay? So you could sustain that loss. Now, the person owning the life insurance policy could sustain, obviously, a loss of death. They're going to lose income. There's going to be money that's going to be lost. Okay? If someone owns a policy on someone else, they have to actually be losing something. So it's when the policy, typically, obviously, if you're insuring your own life, there's insurable interest. But this gets into as well, like, if someone makes $50,000 a year, there's no insurable interest for them to get a $10 million life insurance policy, because that's like just 200 years of income or whatever. So the amount, someone can't just go get a massive policy because like that if they don't have the income or assets to justify them needing that much life insurance. Because there's no insurable interest. If that was the case, I mean, people would just gamble and get that. So there has to be like a reasonable interest that's being insured. Okay? So, like if a third party owns the policy on someone else, so in the second scenario, if you have someone or a company owning a policy on someone else, they have to sustain a loss. So like a wife who is stay-at-home mom could own a policy on her husband, who is the breadwinner, right? Because if he dies, she loses an income stream. Okay? I hate to keep it, the standard stereotypical thing there, but that's just an example. I hope I didn't offend anybody. But that's, that's how it is. There's a loss that will be sustained. If a business has a key employee that brings a lot to the business, say it's a CFO or a CEO of the company, if that person dies, that company's out of like some serious stuff. They're going to have to spend a lot of money trying to find a replacement. They're going to lose some revenue. So there is an insurable interest where, hey, if this person dies, this company's going to lose something. Okay, so where that comes into, you can't just go, bottom line, you can't just go get a life insurance policy on anybody. Like, I couldn't go get a life insurance policy on Elon Musk unless I was really going to sustain a loss from that, okay? That's called a Stoli, a stranger-owned life insurance. We'll get into that in a minute. But there has to be insurable interest. So if you're selling larger, if you're going to work for a company like that sells larger whole life policies, and you're going to take kind of like the financial advisor route, where insurable interest will come up is be like, hey, does this person have debts or income and assets in quantities great enough to justify the amount of coverage that you're applying for? Okay, that's the biggest thing. So someone can't apply for like something that's way outside their means. And then also, insurable interest will come in if someone's sustaining a loss. So we sell final expense life insurance, right? So like if a son gets a policy on his dad, there's insurable interest. Dad dies, son has to pay for the funeral. Okay, that's insurable interest. The son's going to lose something. He's going to have to. There's going to be a loss there sustained. If you have any questions about that, post it in the comments, and I can help you out a little bit more. Hopefully that helped you with that. The beneficiary does not have to show insurable interest. So the beneficiary does not have to show insurable interest. Sources of underwriting information. This is so as they're underwriting, the next part we're going to go into is the sources of underwriting information. So when you apply for a policy with a client, there are sources of information that the insurance carrier is going to use for underwriting to determine how they're going to approve, if they're going to approve someone, and what rate they'll approve them at. This can get into occupational stuff. It can get into habits. It can get into health, obviously, gender, age, tobacco use, stuff like that. I'm going to dig into this a little bit to show you the sources of where this information can come from. First of all, the application. The application is going to have a bunch of information. This is a key source. This is the key source. The first source is the application. So there may be health questions on the application. There may be other things that help the company identify what program this client's going to qualify for, if they can qualify at all. So the application is going to be a huge source of underwriting information. In the agent's report on every application, you will see a section called Agent's Report. And here is where you can put notes as an agent. So here's where you put your own notes for the insurance company to say, hey, a client said they didn't smoke, but their house smelled like cigarettes and they live alone, and no one had been over for 3 weeks, and it smelled like someone had just smoked a cigarette, so I would advise to give them tobacco rates, okay? So the agent's report is where you can kind of take your notes and put your own personal information in there, personal notations based on your interactions with the client, to make sure that the insurance company is getting the best information possible. So it's kind of just like a little notes side section version. It's very important, but where you can put that stuff. It's any information that you think will affect underwriting, any information about the insured that you think may affect underwriting. Next, there's investigative consumer reports. So typically these don't run credit checks, but it gives a general idea of the client's financials, work, hobbies, habits, stuff like that. We'll get into these a little bit in a second here, exactly what they are. But there's the Fair Credit Reporting Act, okay? The Fair Credit Reporting Act is an act that, it's a law, okay? I'm gonna check here exactly when it was started. It was started in 1970. The Fair Credit Reporting Act was started in October 26, 1970. And really what it does, it establishes procedures that consumer reporting agencies must follow so that the information procured is accurate, confidential, relevant, and used properly. So a consumer report, just to give you a definition here, a consumer report is any written or oral communication that bears someone's creditworthiness, credit standing, capacity, character, general reputation, personal characteristics, mode of living. So a consumer report is kind of just like, it gives you an idea of the person's personality, lifestyle, characteristics, stuff like that. Protects, this law here, the Fair Credit Reporting Act, what it really does is it protects consumers against the circulation of obsolete or inaccurate personal financial information, right? So for instance, like, if a company gets word that this person did this thing and it's really bad, but it's not true, like, it protects the consumer from having that information just circulate around. So there are certain procedures and guidelines that companies must follow when analyzing consumer reports and using consumer reports in underwriting, because it has to protect the person, right? Say there was an article that was in the newspaper that was totally slanderous and wasn't true, and it was found out not to be true, then that person has to be protected from that information being used against them. right? It's like, hey, this was in the newspaper. We all know how true the news is, right? So it's like, it's a way to protect that individual. Bottom line is really what it is. It's for the client's best interest. Now, when insurance carriers request information from consumer reports or investigative consumer reports, we'll get into the difference here in a second, they will be subject to civil action for failure if they don't comply. If they don't comply with the Fair Credit Reporting Act, they're going to be subject to civil action. So when they request information from consumer reports or investigative consumer reports and they don't follow the right steps, they can be subject to regulatory action, civil action due to the Fair Credit Reporting Act. You'll see stuff about the Fair Credit Reporting Act in the life insurance application. We read a disclosure every application where it says something with it. So if you obtain information from a consumer, from a consumer reporting agency under false pretenses, you could be subject to fines and up to 2 years imprisonment. So if someone goes and gets the information under false pretenses, then they could be subject to imprisonment or fines. Okay, it's important as you're going through and studying that you understand what some of these penalties are. I remember when I took, there were some questions on that. So you don't want to. The bottom line saying, like, if you go under and you get if you go and get information on consumer reports saying you're someone that you're not, or you're doing it for a reason that you're not, it's subject to fines and prison time. Anyone who unknowingly, so if you violate the Fair Credit Reporting Act and you don't know that you are violating it, or the insurance carrier doesn't know that they're violating it, that company will be liable to any amount of money lost to the consumer plus any legal fees. So if someone violates the standards and they don't know that they're violating it, they are subject to pay whatever the court defines that they are liable for. That would be counted as a loss towards the person who the records were obtained for. I don't know exactly how they go into the calculation for that. That's kind of up in the air. I'm sure it depends on the situation. If you willfully violate the Fair Credit Reporting Act and you bypass any of the procedures and practices that they have in place, it's a $2,500 fine. So a consumer, which in 1970 was probably a lot bigger deal than it is now, right? A consumer is able to view the information in their consumer report if they're declined or their plan is modified or changed based on information in the report. So if a consumer applies for a life insurance policy and their plan is declined or modified because of information in a consumer report, they must be notified of the agency that provided the report. They have the right to know what was in the report. They're able to challenge anything in the report. And that if they challenge something that comes back in the report, they say, hey, that's not true, then the reporting agency has to investigate it. And if the information originally given ends up being false, the agency has to report it to anyone who has sent the false information in the last 2 years. So say Johnny applies for life insurance and the insurance carrier looks and says, oh, Johnny smokes, and Johnny actually got arrested for stealing a pack of cigarettes 5 years ago. And then Johnny says, stealing a pack of cigarettes? No, I don't. I roll my own. Right? Or I never stole a pack of cigarettes. The consumer reporting agency has to go investigate that if Johnny challenges it. And then if they come and find out that Johnny actually didn't steal a pack of cigarettes, he was wrongfully accused, then they have to report that to every other agency out there, or every other source that they gave that information to in the last 2 years. Okay? So small policies, you typically less than $150,000, have limited information in consumer reports. So the report can't provide information on bankruptcies over 10 years ago. If someone's applying for a loan or a policy, we'll keep it about insurance. If someone's applying for a policy, for a life insurance policy, typically like $150,000 or less, there's limited information in the consumer reports. There won't be any bankruptcies from over 10 years ago. Civil suits, arrests or convictions over 7 years ago. So the look back period is a little less if they're applying for less insurance. And this information can't factor into the determination of approval for applications for credit or insurance policies less than $150,000. So if it's less than $150,000, any arrests, civil suits, or convictions over 7 years don't count, and any bankruptcies over 10 years ago don't count. That's something that you'd want to know. That's probably in your study guides there. A consumer report is just written in oral information regarding the insured's credit, character, reputation, or habits based on employment records, credit reports, and other sources. Okay, so it's written or oral information regarding their credit, character, reputation, or habits based on employment records, credit reports, or other sources. All right. You can look the definition of that up based on the Fair Credit Reporting Act. I'll post it up here too, and you'll be able to see that. So investigative consumer reports. An investigative consumer report is when there's an interview done with a friend, associate, or someone else about the insured. The insured has to be notified about an investigative consumer report within 3 days of it being requested, and the reporting agency has 5 days to give any additional information requested by the insured. Okay, so that's an investigative consumer report when the insurance company kind of goes and meets with someone. You're going to want to learn those time frame guidelines. They must be notified of the report within 3 days of it being requested, and the reporting agency has 5 days to give any additional information requested by the insured. Okay, the MIB, Medical Information Bureau, is another source of information for underwriting. The Medical Information Bureau, or the MIB, is a membership corporation owned by insurance companies. It's owned by about 430 life insurance carriers in the U.S. and Canada, and they essentially share information that they obtain about insured or people applying for life insurance so that they can help each other out. Hey, this person applied, they got this issue, this is what's going on. Or some doctor entered a record and it came up in the Medical Information Bureau like this was an unresolved issue, this is something that needs to be handled, or this is something that the person had. So it receives medical information from different insurance companies and maintains confidential information on people. So it does have medical information in there that it has to keep confidential, but it's so insurance companies can help each other out so that one person doesn't go apply at one company and then they figure out something's wrong with them and they say, hey, maybe this other company won't find out. Then they go apply somewhere else. And it's so that those companies can watch each other's backs, essentially. So it compares medical information based on what other insurance companies have discovered. All right. The applicant can't be refused coverage based on Medical Information Bureau notifications, but it can prompt records being required, like physician statements and letters, or a checkup on them, or something like that. So it can prompt a further investigation. So one thing that you'll see a source of information is medical examinations as well. So medical examinations are for higher face amount policies or applicants with challenged medical history, meaning their health isn't that great, that have hits on MIB or the Medical Information Bureau or consumer reports. So if someone's applying for a ton of insurance, they may need a medical examination, or if they have challenged health history that came up on doctor's records or Medical Information Bureau or consumer reports, then they may have to have a medical examination done before they can get approved for insurance. It's a paramedical report is what it's called. A paramedic, like a person who works in an ambulance, or a registered nurse, an RN, they complete this, usually at the individual's house. So what they'll do, they'll drive to the house, they do a medical exam, sometimes they take blood tests, sometimes they do height and weight measurements, drug tests, stuff like that. That's done at the insurance company's expense. The insurance company has to pay for that. So an APS, an attending physician statement, or an APS, is a statement from a doctor, okay, or doctor's records, okay? So it's like doctor's records on the insured. HIV tests are common for coverage as well. The insurance carrier must disclose the use, obtain consent in the dissemination, and give the person the procedures and policies established for how that information will be disseminated through the insurance company's databases. There's a law called the HIPAA. You probably heard of this. It's the Health Insurance Portability and Accountability Act, HIPAA. It's a federal law that protects health information. So it protects your health information so that everybody can't just go view your health information, and so that doctors and hospitals and insurance carriers have to keep it safe and they can't just share it with other people. So like if you applied for a life insurance policy and you got declined, your friend or family member couldn't just call and ask why you got declined, what the health information was that prevented you from being qualified. Only you could obtain that information, and they have to report that to you, okay? So It protects individually identifiable health insurance information, and individually identifiable health insurance, like demographic data that relates to physical and mental health. So essentially, it holds information that it's identifiable to physical and mental health on you. All right, it's protected health information, and there's a privacy rule. So patients have the right to view their own records and know who accessed their records as well. So they can view their records and access them. Okay? Patients have the right to see their records, and they have the right to see who saw their records too. Okay? That's what it means. And it allows disclosure to public health officials for the purpose of preventing disease spread. So, like, some of the information is disclosed without prior authorization to public health officials if a person's got like some crazy disease that they don't want spread out. Okay? So there are certain things for the use and disclosure of health information that you're going to want to know. The client must be given a written disclosure statement with basic information about the cost and coverage of insurance that they're going to be offered. Okay, they must be given at the time of application. They must be given this at the time of application or before before the application to sign. Okay, so they have to be given this disclosure statement with basic information about their insurance that they're being offered before the application or at the time of application. Now, the disclosure authorization notice, must be provided to the applicant by the insurer before obtaining information from outside sources to show how the insurance company collects and uses personal information. So what this means is the disclosure of health information is called the disclosure authorization notice, is what they sign. This has to be signed, and it has to outline how the insurance company is going to obtain the protected information on the client, and the client has to approve and say, yes, this is okay. It's just a signature. Honestly, most people never read it, but it is on the application for someone to sign. Don't let me get caught saying most people don't want to read it. Risk classification. So this is the next thing we're going to cover is risk classification. So how does the insurance company determine what someone qualifies for? Well, the higher the risk, the higher the premium amount, right? So if you're older, your premiums are higher. You're a higher risk. If you smoke, your premiums are higher. You're a higher risk. If you're a guy, your premiums are typically higher. You're a higher risk to the insurance company. If you've had a challenged health history, if you've had some hiccups or some serious conditions, then your premiums are going to be higher. All right. The underwriting department looks at the following things. They look at medical history, your present physical condition, your occupation, and your habits and morals. So medical history is like, hey, what have you had in the past for some health issues? Do you ever have cancer, heart attacks, strokes, things like that? Present physical condition. What's your height? What's your weight? What's your current health right now? What medications you taking right now? Occupation. What do you do for work? Do you skydive professionally, right? As an instructor, a skydiving instructor. Well, that's probably a little bit more risky than someone who works in their home office. Habits and morals. So this gets back to like a skydiving thing, for example. If someone does like skydiving every weekend, or they like participate in drag races or like high-speed motorcycle races, that's a habit that would impact underwriting for sure. And then morals, it's like criminal history, stuff like that. Like what is this person's morals? Will this impact how long they live? So there's 3 general classifications that they typically teach you about in the courses for a life insurance exam. Insurance companies can get a lot more detailed with how their classifications are broken down. But the insurance company, in the licensing course that we use, ExamFX, they really just cover like a couple. So preferred classification, lower premiums, great health. So you're saying, hey, you are above average health for your age. Above average risk, I should say. So you are like above average risk. Like you're a good risk. So we're gonna give you lower premiums, and you're good. We think you're gonna live a long time. Then there's standard risk. So that's no extra rating. It just says your current situation represents the majority of people at your age with similar health, morals, habits, medical history, physical conditions, occupation, stuff like that. Okay? And then there's substandard risk, which is high risk, saying, hey, you're not acceptable at the average rate due to your health history, occupation, habits, and morals. You are a bigger risk to us, bottom line. So we are going to charge you more money. Okay? I should restate how the preferred risk is. They're actually a lower risk to the insurance company. I know I said above average, but they're actually a lower risk to the insurance company. I kind of got confused on that. I didn't want to confuse on that. So preferred means lower risk. Standard means normal risk. Substandard means very high risk. And their premiums are higher, right? The riskier you are to the insurance company, the more you're going to pay. And then there's decline risk that are just not acceptable to the insurance carrier at all. Or there could just be no insurable interest as well. So with that no insurable interest, we're going to get into real quick Stoli, S-T-O-L-I, stranger originated life insurance. Insurance companies do not like this. The government does not like this. It's not ethical. A Stoli, a stranger-originated life insurance policy, is purchased by a stranger on someone else's life with the intention of selling the policy or profiting off of it. So it's getting a policy on someone solely to make money. Like you're not liable for any loss if this person dies. So it could be like, I want to get a $100 million policy on Elon Musk because, man, I want that. That's kind of messed up, right? To want to profit off someone's death, like without any you sustaining any loss, solely a gain. It's not okay because it violates the insurable interest principle we talked about in the beginning. Now, this is not the same as a life settlement. So a life settlement, I'll give you an example on this. A life settlement, also called a viatical settlement, I believe. Say you own a life insurance policy on someone and you had insurable interest. So like if I had a life insurance policy on my dad for like $1 million, say he was going to die and if I relied on his income or whatever, okay? So if I had that insurance policy on my dad for $1 million and he got really sick and I needed the money up front and I needed to take care of him, if he needed all this extra care but I didn't have it, and we're like, hey, just wait, like the money's sitting in the death benefit, but we need it now because we're broke now, then what someone can do is sell that policy. Be like, look, my dad, the doctor said he's got less than 2 years to live. Buy this policy from me for $750,000. When he dies in 2 years, you're going to get $1 million. That's a viatical settlement. A lot of companies honestly really don't like those either. So a lot of them have like a terminal illness benefit set up so that if someone is terminally ill, they can get the money advanced to them ahead of time, and that helps prevent those viaticals, those life settlements. But that's different than a Stoli. Stolis are prohibited by insurance carriers, and they do everything they can to prevent them. So they're really big on, hey, who's this person owning the policy? What relationship do they have to the individual that's applying for insurance? What loss are they going to sustain? Okay? So I hope that covered I hope that gave you a general idea of how companies underwrite for insurance and what you'll need to know for the life insurance exam when it comes time to take your test. Thank you.